Good day, everyone. Today's session will focus on one of the most complex areas of transfer pricing, intangible assets. So, Module 21, we will be looking at transfer pricing for intangibles. These assets, which include intellectual property, trademarks, patents, proprietary technologies, and other intangibles, are often highly valuable and integral to the operations of multinational enterprises. Accurately valuing these intangibles is critical to ensure compliance with arm's length principle and to avoid disputes with tax authorities. We will cover key valuation methods, compliance requirements, and practical case studies on how to manage transfer pricing for intangible assets effectively. So let's get at it. Valuation of intangible. So let us begin with the definition of intangible assets in the context of transfer pricing. These assets, unlike tangible goods, do not have a physical form but carry significant economic value. Common examples include patents, trademarks, copyright, and proprietary technologies. Given their often unique and complex nature, valuing these assets can be a challenge. Now, let's look at key consideration. First of all, we'll consider types of intangibles. Marketing intangibles. These intangibles, or rather, these include assets like trademarks, trade names, and customer lists. So let me take it again. Marketing intangible include assets like trademarks, trade names, and customer lists. These are often closely tied to the brand and market presence of a company and are vital for revenue generation. For trade intangibles, this category covers patents, proprietary technologies, know-how, and trade secrets. These are often the backbone of innovation within a company and carry significant intellectual capital. Understanding the type of intangible is essential as it impacts how we approach the valuation. Now, let us go to valuation methods. Each method has its own strengths depending on the nature of the intangible asset being transferred. So, first method that we'll be looking at is comparable uncontrolled price method. This method compares the price of the intangible in question with prices in comparable transactions between independent entities. It is a direct comparison method but can be challenging to apply if comparable transactions are difficult to find. The relief from royalty method. Here, the value of an intangible is estimated by calculating the present value of future royalty payments that would be saved by owning the intangible. This method is especially useful for valuing intellectual property like patents or trademarks. Income-based method. These methods, such as discounted cash flow, value the intangible based on the expected future income it will generate. Discounted cash flow is commonly used for software, proprietary technologies, and patents because it captures the future economic benefits of the intangible. Now, the next one is cost-based method. These methods estimate the value based on the costs incurred in developing the intangible, adjusting for factors like obsolescence and economic depreciation. This method is useful for valuing internally developed assets where income or market data is not readily available. Now to market-based methods. This approach uses market transactions of similar intangibles to determine the value. Like COP method, it relies on the availability of data on similar transactions in the open market. So let's move to consideration for valuation. When valuing intangible assets, there are several important considerations to keep in mind. Now, let's look at unique and proprietary nature. The more unique the intangible, the harder it is to find comparable transactions. This requires adjustments and careful consideration during valuation. Now, another consideration is economic life. The value of an intangible is closely tied to its expected economic life. That is, how long it will generate income or provide competitive advantages to the business. Market conditions, economic factors, industry specific dynamics, and geographic market conditions all impact the value of intangibles. Now, on usage and exploitation, the value is also influenced by how the intangible is used within the business, whether it is critical to operations or simply a supporting asset. Now, let us look at compliance requirement for intangible assets. Let's move on to compliance. Given the significant value that intangible assets often represent, tax authorities are particularly focused on ensuring that their transfer pricing adheres to the arm's length principle. Proper compliance requires thorough documentation, functional analysis, and adherence to both international and local guidelines. Let's look at the key compliance requirements. Documentation. We've been talking about transfer pricing documentation in most of the modules. Now, under documentation, we have the master file. The master file provides detailed information on the group's intangible assets, including their development, ownership, and exploitation strategies. It helps provide a global overview of how the multinational enterprise intangible assets are managed. For the local file, this file contains specific details on transactions involving intangibles within each jurisdiction. So it also includes the transfer pricing methods applied to value these assets. With respect to supporting documentation, this include the functional analysis, economic analysis, benchmarking studies, contract agreement related to the intangible asset transferred. So those are the supporting documentation that is required. Now we move to functional and economic analysis. Value contribution. A comprehensive analysis of the functions performed, assets used, and risk assumed by each entity in the development, enhancement, maintenance, protection, and exploitation (DEMPE) of the intangible assets is crucial. This helps establish the rationale behind the pricing. Comparability analysis. Identifying comparable transactions and adjusting them to account for the unique characteristics of the intangibles being transferred is critical for ensuring that the valuation adheres to the arm's length principle. Now we move to the regulatory alignment. The OECD guidelines provide a framework for valuing intangibles and determining arm's length prices. Compliance with these guidelines is essential for global multinational enterprises. Local regulation. It is equally important to adhere to the specific transfer pricing regulation and requirement of local tax authorities. In this case, we have the Nigerian Transfer Pricing Regulation 2018. Audit preparedness. We always talk about conducting health check or conduct internal review. Companies should conduct internal reviews and audits to ensure their compliance with transfer pricing regulations on an ongoing basis. Proactive engagement too. Engaging proactively with tax authorities to clarify compliance issues and document efforts to adhere to local and international guidelines can significantly reduce the risk of dispute. So now let's go to case study 1. To help solidify our understanding, let's now look at a few practical case studies that illustrate how companies approach the valuation and transfer pricing of intangible assets. So, for example, valuation of patents for a pharmaceutical company. So, XYZ Pharmaceutical is a multinational pharmaceutical company. Transfer its patented drug formula to a related manufacturing subsidiary in a different jurisdiction. Now, let's look at the implementation. Now, they've used the valuation method. XYZ Pharmaceutical uses this valuation method. XYZ Pharmaceutical uses the relief from royalty method to value the patented drug formula. The company calculates the present value of future royalty payments saved by owning the patent, providing a clear basis for the valuation. Now, the economic analysis. XYZ Pharmaceutical conducts an economic analysis estimating the future revenue generated by the patented drug. An appropriate discount rate is applied to determine the present value. With respect to documentation, they've prepared a comprehensive documentation including the functional and economic analysis, and they've also supported the valuation via other necessary benchmarking studies to support the valuation. Of course, the outcome, detailed documentation ensures compliance with transfer pricing regulation. Also, on tax efficiency, the valuation method optimizes the tax position of both entities, reflecting the economic benefit of the patent. So let's move to case study 2. Case study 2, we'll be looking at transfer of marketing intangibles for a consumer goods company. So ABC Consumer Goods Limited transfer its trademark and customers list to a related distribution subsidiary. Now, on the implementation, ABC Consumer Goods Limited uses the comparable uncontrolled price method to determine the arm's length price for the trademark and customer list. The company identifies comparable transactions between independent parties. Now, with respect to functional analysis, a functional analysis assesses the contribution of each entity in developing and maintaining the marketing intangibles. Documentation, detailed contracts, benchmarking studies, and functional analysis also justify the transfer price. Definitely, the outcome, the COP method ensures that the transfer price reflects the market value of the intangibles. Audit preparedness is also key. The comprehensive documentation helps prepare for potential audit by the tax authorities. Now, on case study 3, where we'll be looking at valuation of proprietary technology for a tech company. DEF Tech Limited, a global technology company, licenses its proprietary software to a related entity for global distribution. Now, with respect to implementation, DEF Tech Limited uses an income-based method, specifically the discounted cash flow analysis, to value the proprietary software. This method projects future cash flows generated by the software and applies a discount rate to calculate the present value. Now, the economic life of the software is estimated based on industry standards and expected period of significant economic benefit. With respect to documentation, detailed documentation include the discounted cash flow analysis, economic assumptions, and relevant market data to support the valuation. With respect to the outcome, the discounted cash flow analysis provides a robust and well-justified valuation, reflecting the true economic value of the proprietary software. So, how this method has actually showed that the valuation was justified. On regulatory alignment, the comprehensive documentation ensures alignment with both OECD guidelines and local regulations, minimizing the risk of disputes. So now that we have looked at everything on the value of intangible assets, so in conclusion, valuing intangible assets for transfer pricing purposes requires careful consideration of the type of intangible, appropriate valuation methods, and thorough documentation. Ensuring compliance with transfer pricing regulations involve conducting detailed functional and economic analysis. Maintaining a comprehensive documentation is also very important, and aligning that documentation with both international guidelines like the OECD and local regulation, in this case Nigerian Transfer Pricing Regulation 2018. Now, all the case studies illustrate practical approaches to valuing patents, marketing intangibles, and proprietary technology, showing how companies can achieve accurate pricing and regulatory compliance by following best practices and leveraging robust valuation methods. Multinational enterprises can effectively manage the transfer pricing of intangible assets, reduce tax risk, and enhance audit preparedness. Thank you for your attention.